In this video, we will be doing technical analysis on the stock market for the week ending Friday, October 16th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for. And I will leave a link to their site in the description box below this video. Thank you for watching this video. My name is Rodney Constable. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals is like having risk radar for the U.S. stock market. The S&P 500 was up 19 basis points for the week, and we closed at 3483.81. The first chart that we're going to look at is a one-year weekly candlestick chart of the S&P 500, so each candlestick does represent 1 week of trading. The blue line is set at 3,500. The reason I did that is I wanted you to see that up to this point, guys, we've had one weekly candle that closed above 3,500. This one here back on August 28th. That was the Friday of that week, and we closed at 3508.01. So far, that is the highest weekly close ever in the S&P 500. And what we can also see here is really since the end of August, since this candle right here, we're stalling. We're stalling on the S&P 500 right at this 3,500 area. We've had some trading almost up to 3,600, as you can see right here. But anything really over 3,500 has been very, very tough. And we'll take a look at that in a couple of other charts here, some shorter charts. But this is telling here, guys, that we're stalling. We're running out of gas. We're running out of momentum. So, could the market continue to go higher from here? Absolutely it could. But the fact that we've gotten right back up to this 3,500 area and we cannot get back above it, we can't close above it, at least so far on the weekly basis, this potentially could be kind of a double top, at least a short-term double top in the market. So we will want to keep an eye on that, and the next week or two will be extremely important in the S&P 500. The other thing I want to point out here is this falling volume as the market has gone up. We saw that back in August, and we know what happened, and we had some selling. So anytime you see falling volume and the market rising, that is a negative divergence. It doesn't mean the market can't continue to go higher, but it becomes challenging. Now let's take a look at a short-term chart to see what happened just this week. So this is a 6-day, 5-minute candlestick chart. So each candlestick represents 5 minutes of trading. The reason I made it a 6-day chart is I wanted you to see where we closed last Friday and the fact that all of this week's gains happened on the gap up on Monday. So you can see here that the first 5-minute candle on Monday, the 12th of October, happened above 3,500. That's this blue line here. And we had a pretty nice day on Monday, but then we sold off on Tuesday, Wednesday. And even though we gapped down on Thursday and closed at the highs of the day, technically we were negative 15 basis points on Thursday. And then you can see here we got a whopping 1 basis point today, okay? So what we can see here is from the opening trade on Monday to where we closed on Friday, that's a downtrend. Again, another example of the fact that we seem to be losing momentum in the market. Yes, we were slightly positive for the week, but when you look at the week's trading action, all of the gains for the week, and again, that amounted to a whopping 19 basis points, okay? All of those gains were right here on the gap up from where we closed on Friday the 9th to where we opened on the very first candlestick of trading, if you will, the first minute of trading on Monday the 12th. So we appear to be stalling here, guys. We're losing momentum. Now, there hasn't been a lot of damage done yet, but the fact that we're losing momentum is not a good thing. The next chart here is a 1 month, 1 hour candlestick chart of the S&P 500. So each candlestick represents 1 hour of trading. And what I've done here is I drew the trend line from where we bottomed when we corrected down to this 3210 area back on September 24th. And I connected the bodies of these candles here. And you can see, even though we dropped down yesterday, we kind of traded right on that trend line, and for the majority of today, we were still above the trend. However, we closed at the lows of the day. We know that. And this hourly candle, as we can clearly see, closed beneath this trend line. So we've had 2 hourly candles, this one here on Thursday, the 15th, yesterday, and this one here that have now closed beneath the trend line on the hourly charts that started back on September 24th. So, we're again just another example that we seem to be breaking trend and losing momentum. And then when we look at this same basic information, but now on a daily chart, again, I connected the bottoms of the candle bodies starting back again. This, the lows that we put in at 32.10, right around 32.10 on the 24th of September. We've had this uptrend that's been attacked. Yesterday's candle closed beneath the trend line on the daily charts, and you can see that today we closed beneath the trend line on the daily chart. And of course, we closed beneath 3,500. So, we're again losing momentum. And on this chart, which by the way is a 2-month chart of the S&P 500, we can see that the highest close that we had on a daily basis on the S&P 500 was back on September 2nd at 35.80.84. And of course, we know that the highest weekly close that we've had is 35.08.01, and that was back on August 28th. Okay, so regardless of how you look at this information, we're stalling. We're stalling on the weekly charts. We're stalling on the daily charts. We're starting to run out of momentum on the hourly charts. Okay, it doesn't mean the market can't go higher next week, but once you lose momentum, once you break trend, it's really hard, at least in the short term, to get that momentum back. So the next week or two is going to be really, really critical in the stock market. Next, let's take a look at a 7-year weekly candlestick chart of the triple Qs, the NASDAQ 100. Of course, this is the high octane area of the stock market. Some of the highest growth rate companies in the stock market are embedded in that NASDAQ 100. And what I want you to see here on this chart, this green line is the 40-week, equivalent to the 200-day, of course, moving average. Look at the gap here, guys. And if we go back to the left, look at over the last 7 years. It's not unusual for the NASDAQ 100, right, the triple Qs, because this is the high octane stuff in the stock market. It's not unusual for it to trade above the 40-week moving average. But look at the gap, okay, and just eyeballing it, you can see that that is a massive gap. By the way, we're up 97 basis points this week in the NASDAQ 100, the triple Qs, but we're trading over almost 21%, but we're trading over 20% above the 40-week moving average on the triple Qs. Doesn't mean we have to pull back anytime soon, but it does make us vulnerable. You can see that, that is a big gap, all right? And when you get this type of a gap above the 40-week moving average, even on the triple Qs, it's not unusual to see us stall and then pull back towards or sometimes right down to that 40-week moving average. So just another data point to express the fact that we may be a little long in the tooth here and prone for some type of a correction within the next few weeks. Next, let's take a look at a 7-year weekly chart of the IWM, which is an ETF that tracks the Russell 2000 Small Cap Index here in the U.S., and the IWM, the Russell 2000 Index, was down 23 basis points for the week, so finished down just a little bit. And you can see that the IWM peaked over 2 years ago in August of 2018. So we've had a lot of sideways trading action with, of course, some downside volatility in the small caps here in the U.S. since really the latter part of 2017. As you can see here, we're trading just barely above where we were almost 3 years ago. So a lot of sideways trading action here. The last couple of weeks up until this week have been very nice in the small caps here in the U.S., which, could bode well going forward. But, again, we saw stalling this week, and the fact that we peaked in this index over 2 years ago, guys, all of this just shows how challenging these markets really are. So, keep in mind that fundamentally, we're going to be down at least 20 to 25% on the earnings on the S&P 500 this year in 2020 versus where we were in 2019. It's likely that it's going to be 2022 before we see normalized earnings for most companies, either small, mid, or large cap, public or private here in the U.S. So there's still some challenges out there, and the fact that we are trading where we are right at all-time highs on the S&P 500 with earnings that are down well over 20% versus where they were a year ago just shows us that we've done this on expanding multiples. So the value in the stock market, at least based on historical norms, is not there. We're trading at very, very high multiples based on historical norms. So let's not get complacent here. Could we go higher over the next couple of weeks? Yes, but we appear to be running out of momentum in the stock market at this time. Let me ask you a question. Do you have a stock market risk management system? Something that helps you understand the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how Simple Market Signals could have helped you in the most recent downturn. We know that we came into the year with a strong stock market, so we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over and that things were changing. And so I gave people a heads up right here over the weekend, and I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the Simple Market Signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this simple market signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal, we had the general trend indicator went negative, and then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, and it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the simple market signals model, there are three powerful indicators. There's the simple market signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service, and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an email newsletter, so we will have to have your best email address on file, and make sure this box is checked, because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system, and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. Now, when you subscribe, okay, understand that everything is tied to your email on file. All right, so once you subscribe, you go out to the website simplemarketsignals.com, and it'll take you maybe 5 minutes to subscribe. It's pretty easy, and you just follow the prompts, and then your email on file is then going to drive everything going forward. This is an emailed newsletter subscription. That's how we disseminate the information, and you should get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter that is automatically generated once you subscribe. So if you don't get that welcome letter beyond your confirmation, okay, of the subscription, if you don't get that welcome letter, if you don't see it in your in-basket, then go check your spam, your junk, or your promotion folders, especially in Gmail. Having a lot of people that are having the newsletters and everything coming from Simple Market Signals going into the promotion folder. So please make sure that you check your spam, your junk, and your promotion folders. And also understand that the newsletters go out on the weekend. All right. So the goal is to get it out Saturdays by 2 p.m., but it could be any time over the weekend, depending on how long it's taken me to do the research necessary for that week's newsletter. But I try to get it out by 2 p.m. Eastern Standard Time every Saturday if I can. Again, earlier if I can make that happen. And then the next edition, right, once you subscribe, understand that the next edition, right, so if you just subscribe on a Monday, Tuesday, Wednesday, whatever, the next regular edition is going to be set out on Saturday. All right, and then once you subscribe, we will send you, as soon as we can, the latest edition, but we have to send that out manually. So just be patient with us. But again, within a day or two of your subscription, if you don't get this latest edition, then go back and check your spam, junk, and promotion folders, because it's probably hidden in there. All right, so you should get the automatic welcome letter, and then the latest edition within the next day or two of your subscription, and then again the standard newsletter goes out every weekend, but we try to make it no later than 2 p.m. Eastern Standard Time on any Saturday.